Welcome back to Finance Friday. It's another special edition of Money Girl where I answer your burning money questions. Today's topic comes from Bill, who says, I maxed out my traditional 401k by contributing $23,000 for 2024 and would like to invest more, but I'm unclear about the rules. I'll have a bigger than normal tax bill because I earned some extra income working a side hustle last year. Can I also max out an IRA, individual retirement account, for more tax deductions? This is a great question, Bill. I appreciate you sending it in. And congratulations on maxing out your workplace retirement account. That's a huge milestone. And for earning extra income to boot. This podcast will review the rules for using multiple retirement accounts in the same year and maximizing potential tax breaks, whether you have a little or a lot of income. Thanks, everyone, for downloading episode 897 of the Money Girl podcast. I'm Laura Adams, an award-winning author, money speaker, on-camera spokesperson, and founder of the Money Stack, my free Substack newsletter. You can learn more and connect with me at lauradadams.com. That's where you can email your money question and sign up for the Money Stack, which gives subscribers a terrific money success toolkit. That's what you get for free just for signing up. You can also record a brief question or comment on our voicemail line by calling 302-364-0308. All right, let's talk about the benefits of using multiple retirement accounts. You know, I think investing through retirement accounts is probably one of the best and easiest tax shelters, which means that they reduce your current or future tax liability. Growing your account balance and cutting taxes simultaneously is a really powerful combination that can help you build wealth. And that's the primary reason why I always recommend making tax-advantaged accounts, like retirement accounts, your go-to for investing. In addition, you can use multiple retirement accounts in the same year. However, how much you can contribute and the tax benefits you get will depend on the accounts you're eligible for and, which ones you choose to use, which ones you actually put money into. For instance, for 2025, if you're like Bill with a workplace retirement plan, most allow contributions up to $23,500 or $31,000 if you're over 50. Now, that's an increase of $500 from the 2024 limits. And those aged 60 to 63 can make even higher contributions, which are called super catch-up contributions, which I've talked about in previous podcasts. Bill mentioned having self-employment income from his side hustle. Well, that qualifies him for a small business retirement plan, like a solo 401k or a SEP IRA, which allow contributions based on your net business income. There's no limit to the number of employer-sponsored retirement accounts you can contribute to. However, you can't exceed annual limits across all of them. For instance, since Bill maxed out his employee contributions to a workplace 401k, he could contribute up to 25% of his self-employed compensation as his own employer to a solo 401k, which allows contribution limits as high as $70,000. You do have to have high income, to hit that amount. Bill asked about using an IRA, and that is an excellent retirement account option when you max out a 401k or a 403b or, whatever workplace account you have. Everyone with qualifying earned income, no matter your age, can use a tax-deductible traditional IRA. For 2025, you can contribute an amount equal to your qualifying income up to $7,000 or $8,000 if you're over 50. You can contribute $7,000 or $8,000 to an after-tax Roth IRA if you have income under an annual threshold. And next, I'll explain the differences between traditional and Roth accounts and the rules for using them in combination with a workplace retirement plan. All right, so let's get into the differences between traditional and Roth accounts. We'll just kind of go through an overview here. Traditional retirement accounts like a traditional 401k or traditional IRA allow pre-tax contributions, giving you a very nice tax deduction in the year you make them. In other words, you skip paying income taxes on the money you invest in a traditional account and also the earnings until you withdraw money from the account in retirement. However, if you tap a traditional account before age 59 and a half, you typically must pay a 10% penalty plus income taxes on any untaxed portion. Therefore, you should only put money into a traditional retirement account that you won't need to spend until retirement. The idea is to keep it there for the long term and avoid any early withdrawal penalties. Roth retirement accounts like a Roth 401k or a Roth IRA require after-tax contributions, which means they don't benefit you in the current year. However, the terrific upside of a Roth is that withdrawals of contributions and your investment earnings are tax-free in retirement, as long as you've owned the account for at least 5 years. You may have significant account growth in a Roth, and all of that growth never gets taxed, which could add up to a massive tax savings. You can even withdraw your original Roth contributions before retirement without owing taxes or that 10% early withdrawal penalty, and that really gives you some nice flexibility that's not offered by traditional retirement plans. So the main difference between a traditional and a Roth account is how and when you pay taxes. Contributions to a traditional account do cut your current tax bill, which is what Bill asked about, and a Roth eliminates taxes on future withdrawals. Note that you can contribute to traditional and Roth accounts in the same year if your combined contributions don't exceed the annual limit. For instance, if you're under 50, you could put $3,000 in a traditional IRA and $4,000 in a Roth IRA for 2025, or any combination. Or, the same thing, you could split it up between a traditional 401k and a Roth 401k at work. Now, while you can max out a 401k or any workplace retirement plan and a traditional IRA in the same year, there are limits that restrict how much your IRA contributions are tax deductible. So let's go through the rules that apply when you or a spouse participate in a retirement plan at work and you also use a traditional IRA, like what Bill is thinking about. Your tax deduction for traditional IRA contributions may be reduced or even eliminated depending on your modified adjusted gross income, or MAGI, and we'll go through the rules for 2025. So single taxpayers get a full traditional IRA deduction with MAGI up to $79,000 and a partial deduction up to $89,000. So there's $10,000 in there where you're going to get a partial deduction, but you receive no IRA deduction at or above MAGI of $89,000. Married couples filing taxes jointly get a full IRA deduction with household MAGI up to $126,000 and a partial deduction up to $146,000. But you receive no deduction at or above $146,000. So if Bill is single with an income less than $79,000 or MAGI less than $79,000, he could get a full tax deduction for any amount that he contributes to a traditional IRA. But if Bill earns $89,000 or more, he won't get a tax deduction for making traditional IRA contributions in combination with his workplace plan. Now, if Bill files taxes with a spouse, he's unable to claim a traditional IRA deduction if his household income is $146,000 or above, as I mentioned. So if your income is below your tax filing status limit and you want an additional tax deduction for the year, contributing to a traditional workplace plan and a traditional IRA is a great option. However, here's another situation that can affect married people. Let's say you're not covered by a retirement plan at work, but your spouse is. For 2025, married couples filing taxes jointly get a full IRA deduction with household MAGI up to $236,000, a partial deduction up to $246,000, and you'd receive no deduction at or above $246,000 of MAGI. So what a lot of higher earning people will find is that their income is too high to qualify for deductible traditional IRA contributions when also participating in a workplace retirement plan or having a spouse participate in a workplace retirement plan. So in that case, you might consider using a Roth IRA instead. Since Roth contributions are non-deductible, remember that means you have to pay them on an after-tax basis, there's never a problem using a workplace retirement plan and a Roth IRA in the same year. However, there's a catch because Roth IRAs have an annual income limit to qualify. So let's go through the Roth IRA income limits for 2025. They have been increased. Single taxpayers cannot contribute to a Roth IRA with MAGI, remember that's modified adjusted gross income, at or above $165,000. Married couples filing taxes jointly cannot contribute to a Roth IRA with household MAGI at or above $246,000. So getting back to Bill's question about whether maxing out a traditional IRA will reduce his taxes, the answer depends on his income and his tax filing status. If he earns too much to get a full traditional IRA tax deduction, but he's under the income limit for a Roth IRA, that would be a terrific option for him. While a Roth IRA doesn't give you an upfront tax benefit, which, I know that's what Bill is looking for, it may provide you with something even better, and that's having tax-free income in retirement. But if Bill has enough business income to make it worthwhile, opening a traditional self-employed retirement account would allow him to make some additional tax-deductible contributions and reduce his tax liability. The younger you are, the more beneficial Roth contributions can be. Bill didn't mention his age or his stage in his career, but if he's a high earner, they typically get more advantages from using traditional retirement accounts. And I'd say if you're unsure whether to choose a traditional or Roth account or how to properly use multiple retirement accounts in the same year, be sure to consult a certified tax professional. They can help you and, make sure that you're set up to optimize your taxes, especially when you have business income. Bill, I hope that's been helpful and helpful to anyone who is trying to reduce their taxes and maybe put a little bit more money in their retirement accounts. Before we go, a quick reminder to subscribe to The Money Stack. That's my Substack newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or become a paid member with access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we have a terrific team. Steve Rickyberg audio engineers the show. Brandon Gaches is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.